short-term or long-term investing, which actually makes you rich. Have you ever stared at your stock app, watching the numbers go up and down, and thought, should I sell now? Or hold it for 10 years and become the next Warren Buffett? Well, here's the truth. Both short-term and long-term trading can make you money, or lose it, spectacularly. It's like dating versus marriage. Short-term trading gives you thrills, long-term investing gives you commitment. But which one makes you happier and richer? Let's find out. Hi everyone, welcome back to the channel. Today, we're breaking down one of the biggest debates in the stock market: short-term trading versus long-term investing. Whether you're a total beginner who just downloaded a trading app yesterday, or someone who's been watching CNBC long enough to know who Jerome Powell is, this video will give you a clear, funny, and wise way to understand what fits you best. What is short-term trading? Short-term trading is like speed dating with your stocks. You buy today, you sell next week or next hour, hoping for a quick profit. The goal: catch short movements in stock prices. The tools: charts, indicators, lots of caffeine. The emotion: adrenaline mixed with panic. Example: imagine you buy Tesla stock at $200 and it jumps to $210 the next day. You sell, make $10 per share, and feel like a genius. Then it goes up another $30 the following week, and you feel like crying. Welcome to trading. Advantages: fast results. You know quickly if you win or lose. Exciting and flexible. Can profit even when markets fall, using short selling or options. Disadvantages: stressful. Your heart rate will rival a Formula One driver. High transaction costs and taxes. Easy to lose money if emotions take over. Short-term trading is great for people who love risk, speed, and charts more than sleep. What is long-term investing? Long-term investing is like raising a tree, not eating the fruit tomorrow, but in 10 years. You buy good companies, hold through ups and downs, and let time and compound interest work their magic. Example: if you invested $1,000 in Apple in 2010, you'd have over $20,000 now. And you wouldn't have had to check your phone every 5 minutes. Advantages: time is your best friend. Compound interest grows quietly while you sleep. Less stress. No need to time every move. Lower taxes, fewer mistakes. Disadvantages: slow results, patience required. You might miss short-term opportunities. Requires trust in the company and in yourself. Long-term investors often look boring, but guess what? Boring often wins. The hybrid wisdom. Now, here's the secret few tell you. You don't have to choose only one. Many smart investors do both. 80% of their money in long-term investments: ETFs, blue chips, index funds. 20% for short-term plays, where they experiment, learn, and sometimes lose heroically. Think of it as: your main meal is healthy, but dessert is allowed. This balance gives you stability and excitement without losing your sanity. What the greats say. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." But Jesse Livermore, a legendary trader, once said, "It never was my thinking that made the big money. It was always my sitting." So whether you sit for 10 minutes or 10 years, the real trick is to have a plan, manage your risk, and never invest money you can't afford to lose. So, should you trade short-term or invest long-term? If you love the thrill, learn trading, but treat it like a skill, not a lottery. If you prefer peace of mind, go long-term, and let compound interest be your silent partner. In the end, money is not just about speed. It's about direction. So, what's your style? Fast and furious or patient and powerful? Tell me in the comments. And don't forget to like, subscribe, and share this with someone who's still trying to time the market. Because remember, Time in the market beats timing the market.